Good morning. Namaskar. This statement today contains broadly four parts. The first part, I would focus on the MPC's decision and the rationale behind the MPC's decision. Together with that, I will brief all of you about RBI's assessment of growth and inflation. In the second part, I have made an effort to provide some guidance on liquidity and financial markets. In the third part, I would be announcing certain additional measures. And finally, in the fourth part, I would be concluding. And in the concluding para also, I would bring out the broad approach of the RBI going forward during this year. So I request your patience. The Monetary Policy Committee met on 2nd, 3rd, and 4th June 2021 and took stock of the evolving macroeconomic and financial conditions, as well as the impact of the COVID wave, the second wave of the COVID, on the economy. Based on its assessment, the MPC voted unanimously to maintain status quo, that is, keeping the policy repo rate unchanged at 4%. The MPC also decided unanimously to continue with the accommodative stance as long as necessary to revive and sustain growth on a durable basis and continue to mitigate the impact of COVID-19 on the economy while ensuring that inflation remains within the target going forward. The marginal standing facility, that is MSF rate, and the bank rate remain unchanged at 4.25%. The reverse repo rate also remains unchanged at 3.35%. Since the MPC's meeting in April, the second wave of the COVID-19 has surged across several states and spread into smaller towns and villages, leaving a trail of human misery and tragedy in its wake. Yet, in these days of trials and travels, it is vital to remain focused on vanquishing the virus. Tough times call for tough choices and tough decisions to emerge triumphant. It is said that storms make trees take deeper roots. I am convinced that as we stretch our endurance to eradicate the virus, it will bring out the finest aspects of human character and capability. I am reminded here of a quote attributed to the Greek philosopher Epictetus, and it goes as follows: "The greater the difficulty, the more glory in surmounting it." Let me begin by setting out the underlying rationale of the MPC's decision. Provisional estimates of national income released by the National Statistics Office (NSO) on May 31st placed India's real GDP contraction at 7.3% for 2021, with GDP growth in fourth quarter at 1.6% year-on-year. The forecast of a normal southwest monsoon, the resilience of agriculture and the farm economy, the adoption of COVID-compatible person operational models by businesses, and the gathering momentum of global recovery are forces that can provide tailwinds to revival of growth, revival of domestic economic activity when the second wave abates. On the other hand, the spread of COVID-19 infections in rural areas and the dent on urban demand poses downside risks. Ramping up the vaccination drive and bridging the gap in healthcare infrastructure and vital medicine supplies can mitigate the pandemic's devastation. The inflation print for April at 4.3% has brought with it some relief and policy elbow room. A normal southwest monsoon, along with comfortable buffer stocks, should help to keep cereal price pressures in check. On the other hand, the rising trajectory of international crude prices within a broad-based surge in international commodity prices and logistics costs is worsening the cost conditions. These developments could keep core price pressures elevated, although weak demand conditions may temper the pass-through to consumer inflation. On balance, the MPC was of the view that at this juncture, policy support from all sides is required to gain the momentum of growth that was evident in the second half of 2021 and to nurture the recovery after it has taken root. Accordingly, the MPC decided to keep the policy rate at the current level of 4% and to continue with the accommodative stance as long as necessary to revive and sustain growth on a durable basis and continue to mitigate the impact of COVID-19 on the economy while ensuring that inflation remains within the target going forward. Let me now provide some more details with regard to RBI's the MPC's assessment of growth and inflation. The second wave of COVID-19 is associated with unexpectedly higher rates of morbidity and mortality relative to the first wave. The breakout of mutant strains that render the virus highly transmissible across both urban and rural areas has led to fresh restrictions on activity being imposed across a large swath of the country. Yet, unlike in the first wave, when the economy came to an abrupt standstill under a nationwide lockdown, the impact on economic activity is expected to be relatively contained in the second wave, with restrictions on mobility being regionalized and nuanced. Moreover, people and businesses are adapting to pandemic working conditions. Urban demand, as reflected in some high frequency indicators, that is, electricity consumption, railway freight, port cargo, steel consumption, cement production, e way bills, and toll collections, recorded sequential moderation during April and May 2021 as manufacturing and services activity weakened due to restrictions and lockdowns imposed by most states. Mobility indicators have declined during April and May, but they remain above the levels seen during the first wave last year. Domestic monetary and financial conditions remain highly accommodative and supportive of economic activity. Moreover, the vaccination process is expected to gather steam in the coming months, and that should help to normalize economic activity. With external demand strengthening, a robust uh, with external demand strengthening, a rebound in global trade is taking hold, which should support India's export sector. Global demand conditions are expected to improve further, buoyed by fiscal stimulus packages and fast progress of vaccination in advanced economies. India's exports in March, April, and May 2021 have launched into an upswing. Conducive external conditions are forming for a durable recovery beyond pre pandemic levels. The need of the hour is for enhanced and targeted policy support for exports. It is opportune now to give further policy push by focusing on quality and scalability. Notwithstanding the sequential decline of indicators of rural demand in April, rural demand is expected to remain strong as forecast of a normal monsoon bodes well for sustaining its buoyancy going forward. The increased spread of COVID-19 infections in rural areas, however, pose downside risks. Taking all these factors into consideration, real GDP growth is now projected at 9.5% in 2021-22, consisting of 18.5% in first quarter, 7.9% in second quarter, 7.2% in the third quarter, and 6.6% in the fourth quarter of 2021-22. Now, turning to the outlook for inflation, the favorable base effects that brought about the moderation in headline inflation by 1.2 percentage points in April may persist through the first half of the year, conditioned by progress in monsoon and effective supply side interventions by the government. Upside risks to inflation emanate from persistence of second wave and consequent restrictions on activity on a virtually pan-India basis. In such a scenario, insulating prices of essential food items from supply side disruptions will necessitate active monitoring and preparedness for coordinated, calibrated, and timely measures by both center and states to prevent emergence of supply chain bottlenecks and increase in retail margins. Taking into consideration all these factors, CPI inflation is projected at 5.1% during 2021-22, and this consists of 5.2% in the first quarter, 5.4% in second quarter, 4.7% in third quarter, and 5.3% in the fourth quarter of 2021-22, with risks broadly balanced. Let me now proceed and provide some guidance with regard to liquidity and financial markets. The foremost endeavor of the Reserve Bank throughout the pandemic has been to create conducive financial conditions so that financial markets and institutions keep functioning normally. And this is something which I think we can say with confidence that the Reserve Bank has been successful in ensuring throughout the pandemic period so far. Accordingly, adequate system level liquidity has been ensured, and targeted liquidity to stressed institutions and sectors has been provided. As a result, borrowing costs and spreads have reduced to historic lows. As a this has incentivized a record amount of private borrowing through corporate bonds and debentures during financial year 2020 and 21. Reserve money rose by 12.4% year on year as on 28th May, and while money supply, that is M3, grew by 9.9% year on year as on May 21st, and bank credit by 6% as on May 21st, 2021. The GSAP operations and some instances of cancellations, devolvement, and exercise of green shoe options in the GSEC auctions have conveyed the Reserve Bank's views to the market. With the second wave intensifying this financial year, the focus of the Reserve Bank is increasingly turning from systemic liquidity to its equitable distribution. In fact, the enduring lesson from the experience of the pandemic in the Indian context has been deployment of unconventional monetary policy measures that distribute liquidity among all stakeholders. We shall continue with our proactive and preemptive approach, relying on market-based channels of transmission as we strive to mitigate the toll of the pandemic and return the economy to a path of high and durable growth. The auctions under GSAP 1.0, and you would recall this is something which was announced by me in the MPC of April this year. The auctions under GSAP 1.0 have evoked keen interest from the market participants, with bid cover ratios of 4.1 and 3.5 respectively in the two auctions undertaken so far. The timing of the second auction was aimed towards replenishing the drainage of liquidity due to the restoration of the cash reserve ratio CRR to its pre-pandemic level of 4% of the net and time demand liabilities NDTL, and this was restored to 4% on 22nd of May, and the GSAP, the second auction under GSAP 1.0 was held just 2 days prior to that. In addition, the redemption of government securities worth around 52,000 crore rupees during the last week of May fully neutralized the CRR restoration. The positive externalities associated with GSAP 1.0 operations are reflected in our other financial market segments also, notably corporate bonds and debentures. Interest rates on commercial paper, 91-day treasury bills, and certificates of deposit also remain low and range bound. In my statement of April 7, 2021, I had indicated that in addition to GSAP, the Reserve Bank will continue to deploy regular operations under the LAF, that is long-term repo and reverse repo auctions, Forex operations, open market operations, including special OMOs, To ensure that liquidity conditions evolve in consonance with the stance of monetary policy and financial conditions remain supportive of all stakeholders. During the current year so far, the Reserve Bank has undertaken regular OMOs and injected additional liquidity to the tune of 36,545 crore up to May 31st, in addition to 60,000 crore under GSAP 1. A purchase and sale auction under Operation Twist has also been conducted on 6th of May this year to facilitate the smooth evolution of the yield curve. Going forward, the Reserve Bank will continue to conduct regular operations for liquidity management. Taking these developments into account, it has now been decided that another operation under GSAP 1.0 for purchase of GSECs of rupees 40,000 crore will be conducted on June 17th, 2021. Of this, 10,000 crore would constitute purchase of state development loans, SDLs, that is the borrowing done by the papers, the borrowing done by the state governments. It has also been decided, I repeat, it has also been decided to undertake GSAP 2.0 in the second quarter of 2021-22 and conduct secondary market purchase operations of rupees 1.20 lakh crore, that is rupees 1 lakh and 20,000 crore, to support the market. The specific dates and securities under GSAP 2.0 operation will be indicated separately. We do expect the market to respond appropriately to this announcement of GSAP 2.0. After a risk-off period of retrenchment in April-May, the prospects for capital flows to India are improving again. While these flows ease external financing constraints, they also impart volatility to financial markets and asset prices while producing undesirable and unintended fluctuations in liquidity that can vitiate the monetary policy stance. This has necessitated countervailing two-sided interventions by the Reserve Bank in spot, forward, and futures markets to stabilize financial market and liquidity conditions so that monetary policy retains its domestic orientation and the independence to pursue national objectives. Thus, the Reserve Bank actively engages in both purchases and sales in foreign exchange market and its various segments. The success of these efforts is reflected in the stability and orderliness in market conditions and in the exchange rate in spite of large global spillovers. In the process, strength is imparted to the country's balance sheet by accumulation of reserves. And let me mention here that as of last Friday, the country's Forex Reserves had touched 598.2 billion US dollars, and this is a figure which will be announced which will be announced as a part of our weekly statement later today. So it can be seen that we are within the striking distance of reaching $600 billion of reserves, and the indications are that we have already crossed 600 billion, but let the figures, after duly verified, let it be released. And as you know, the figures for this Friday will be released next Friday. So it is our expectation that based on current assessment, we feel that our reserves have already exceeded 600 billion US dollars, and that is something which gives us great amount of confidence to deal with the challenges arising out of global spillovers should they happen at a future date. Yet another issue that has generated wide-ranging interest and discussion among economists, market participants, and analysts is the role and nature of our forward guidance. As you would recall, in April, the MPC had decided on a state-based rather than time-based forward guidance. Recognizing that it is difficult in the context of the pandemic to perfectly foresee how the economy evolves and when the economic recovery gets firmly entrenched. Amidst such all-pervasive uncertainty, the Reserve Bank will continue to use all instruments all instruments at its command and work to revive and sustain growth on a durable basis. Needless to add, the consistency and credibility of our communications are reinforced by our visible actions. I would like to emphasize that in the whole process of fighting against the pandemic, the strength of the financial system is extremely crucial. Building adequate provisioning and capital buffers, together with sound corporate governance in financial entities, have become much more important than ever before, more so in the context of banks and NBFCs being at the forefront of our efforts to mitigate the economic impact of COVID-19. The Reserve Bank remains fully committed to creating an enabling environment in which a sound and efficient financial sector flourishes while preserving financial stability. Against this backdrop, and based on our continuing assessment of the macroeconomic situation and financial market conditions, certain additional measures are being announced today. The details of these measures are set out in the Statement on Developmental and Regulatory Policies, which is Part B of the Monetary Policy Statement. As you would be aware, my statement, which I am making just now, together with the statement of the MPC and the additional measures which we are announcing, which are Part B of the MPC resolution, all of them will be uploaded on the RBI website immediately after my statement is over. Now, the additional measures are as follows. The first one relates to on-tap liquidity window for contact-intensive sectors. In order to mitigate the adverse impact of the second wave of the pandemic on certain contact-intensive sectors, a separate liquidity window of rupees 15,000 crore is being opened till 31st March 2022, with tenors of up to 3 years at the repo rate. Under the scheme, banks can provide fresh lending support to hotels and restaurants, tourism, that is travel agents, tour operators, and adventure and heritage facilities, aviation ancillary services, that is ground handling and supply chain, and other services that include private bus operators, car repair services, rent-a-car service providers, event or conference organizers, spa clinics, and beauty parlors and saloons. By way of an incentive, banks will be permitted to park their surplus liquidity up to a size of the loan book created under this scheme with the Reserve Bank under the reverse repo window at a rate which is 25 basis points lower than the repo rate, or termed different in a different way, 40 basis points higher than the reverse repo rate. And from the list, it can be seen that most of the entities, most of the borrowing units under these categories would qualify to be MSMEs. So they will also get, such of them which have the required turnover within the MSME limit will automatically get classified under the priority sector lending classification of the banks. The second measure relates to special liquidity facility to the SIDB. To nurture the still nascent growth impulses and ensure continued flow of credit to real economy, the Reserve Bank had extended fresh support of rupees 50,000 crore, 50,000 crore on 7th April to all India financial institutions for new lending in 2021-22. This included 15,000 crore to Small Industries Development Bank of India, that is SIDB, to further support the funding requirements of micro, small and medium enterprises, that is MSMEs, particularly smaller MSMEs and other businesses, including those in credit deficient and aspirational districts. It has been decided to extend a special liquidity facility of rupees 16,000 crore to SIDB for on-lending or refinancing through novel models and structures. The details, of course, will be spelled out by the SIDB in their own, through their own circulars and communications. This facility and this announcement is based on our discussion with SIDB. This facility will be available at the prevailing repo rate for a period of up to 1 year, which may be further extended depending on its usage. The next announcement relates to enhancement of the exposure thresholds under Resolution Framework 2.0. The Resolution Framework 2.0, announced by the Reserve Bank on 5th of May, provides for resolution of COVID-19 related stress of MSMEs as well as non-MSME small businesses and loans to individuals for business purposes. With a view to enabling a larger set of borrowers to avail of the benefits under the Resolution Framework 2.0, it has been decided to expand the coverage of borrowers under the scheme by enhancing the maximum aggregate exposure threshold from 25 crore to rupees 50 crore for MSMEs, non-MSME small businesses, and loans to individuals for business purposes. The next measure relates to placement of margins for government securities transactions on behalf of the foreign portfolio investors. The Reserve Bank has been taking several measures to encourage investments by FPIs, that is foreign portfolio investors, in the Indian debt market. With a view to easing operational constraints faced by FPIs and promoting ease of doing business, it has been decided to permit authorized dealer banks to place margins on behalf of their FPI clients for their transactions in government securities, including state development loans and treasury bills, within the credit risk management framework of the banks. The next announcement, the next measure relates to facilitating flexibility in liquidity management by issuers of certificates of deposits. In December 2020, regional rural banks were permitted to access the liquidity windows of the Reserve Bank as well as the call and notice money market in order to facilitate more efficient liquidity management by the regional rural banks, that is RRBs, at competitive rates. To provide greater flexibility in raising short-term funds by RRBs, it has now been decided to permit RRBs to issue certificates of deposit. It has also been decided that all issuers of certificates of deposits, that is CDs, will be permitted to buy back their CDs before maturity subject to certain conditions. This will facilitate greater flexibility in liquidity management. The next announcement, and this is the last one, relates to availability of National Automated Clearing House, NAC. I repeat, National Automated Clearing House, NAC, on all days of the week. NAC, a bulk payment system operated by the NPCI, facilitates one-to-many and also many-to-one credit transfers such as payment of dividend, interest, salary, pension, etc., as also collection of payments pertaining to electricity, gas, telephone, water, periodic installments towards loans, investments in mutual funds, insurance premium, etc. NAC has emerged as a popular and prominent mode of direct benefit transfer, that is DBT, to large number of beneficiaries. This has helped transfer of government subsidies during the present COVID-19 in a timely and transparent manner. In order to further enhance customer convenience and to leverage the 24/7 availability of RTGS, NAC, which is currently available on bank working days, is proposed to be made available on all working days of the week. I correct myself. It is now proposed to be made available on all days of the week effective from 1st August. So till now it was available on the bank working days. Now it will be available even on bank holidays. The relevant instructions, circulars for all these measures will be issued separately. Let me now conclude my statement today. In the year gone by, the Reserve Bank has engaged in safeguarding the economy and the financing system from the ravages of the pandemic. We have been on continuous vigil through the first wave, the lull between the waves, and now in the second wave. Maintaining financial stability and congenial financing conditions for all stakeholders is a commitment that we have adhered to assiduously. The sudden rise in COVID-19 infections and fatalities has impaired the nascent recovery that was underway, but has not snuffed it out. The impulses of growth are still alive. Aggregate supply conditions have shown resilience in the face of the second wave. We will continue to think and act out of the box, planning for the worst and hoping for the best. The measures announced today, in conjunction with other steps taken so far, are expected to reclaim the growth trajectory from which we have slid. Looking ahead, a policy package to consolidate India's position as vaccine capital of the world with leadership in production of pharma products can change the COVID-19 narrative. The need of the hour is not to be overwhelmed by the current situation, but to collectively overcome it. Amidst the uncertainty and the lingering gloom, there have been many instances of rare courage and indomitable spirit, entrenching a strong faith in the future of our nation. Our resilience, our conviction, and our hope can best be summed up in the words of Mahatma Gandhi, and I quote, I have never lost my optimism. In seemingly darkest hours, hope has burnt bright within me. Thank you. Stay safe. Stay well. Namaskar.